Hey there, my name is John Stevenson. Welcome to the Guaranteed Retirement Guy Show. We're going to be talking about how to protect your retirement against inflation and taxes, two of the biggest challenges that we face when we retire. So if you are retiring and you're worried about the value of the income that you're receiving going down due to taxes and inflation, and you're trying to figure out the best ways to combat that, we're going to talk about those. So I'm going to show my screen. I'm going to share some simple strategies that you can use. Of course, I use annuity contracts as part of my strategy. I do like the guarantees, and there are ways that you can do this and combat inflation with several contracts or with just one. And then I like being able to also use the stock market, even if I'm older. And a lot of people, when they are retired, will use the stock market as well, which of course, stock market is one of the best ways to combat against inflation. But most of us, when we're retired, we're like, I don't want to be in the stock market. I don't want to experience the fluctuations up and down anymore. But I know that that's probably the best way to combat inflation. So how do I do that and still protect myself? Because that's really important. And then what about taxes? Okay, you got IRMA. A lot of people are worried about that, and they're worried about making too much. And so that can cause them to try to keep their income as low as possible. And so they will reach out to me a lot of times and try to figure out strategies for keeping income lower, but still having lifetime payouts from these annuity contracts. So I'm going to share my screen. I want you to see exactly what's available here. And then we'll kind of work through these numbers together as far as how do we avoid paying, we don't want to pay any taxes, of course, but sometimes we do, and there are ways, of course, to avoid that or at least reduce it. So, all right. So let's take a look at this. We'll say that this couple, they live in Tennessee. They're both 62. The amount they want to invest into an annuity contract is $400,000. Okay, they're both wanting to retire in 3 years. So they've got money maybe in a 401k sitting there or an IRA, and they just want to put something into this that will provide lifetime income in conjunction with their Social Security and maybe a pension payout. So with this, they're going to get $35,642. That's the highest, and you see Corebridge followed by Nationwide and F&G. And that's if they defer it out 3 years. If they were to defer it out longer or put it in earlier and then defer it out to 65, they get a much higher payout. So, and of course, if it's immediate payout, it's less than that. So you just have to kind of do the proper planning. So, and we can talk about that. If you want to book a call with me, there is a link below this video. If you're looking to purchase an annuity, I'd love to help you. There's a link on my website, johnstevenson.com as well, where you can go there, check out annuity contracts for yourself, see what they're paying, and then you can reach out to me there as well. Okay, so we got $35,642. That's the highest payout. That's with Corebridge. And again, we're going to be talking about, well, how can we combat inflation, right? Because this doesn't change. I mean, if you look at the income, it's consistent. I mean, it's pretty good. I mean, it pays out $1.1 million until, by the time you're 95, but if you live longer, it's going to continue to pay out. So if you live another 10 years longer, maybe you got longevity on your side, it's going to pay another $350,000. So it's a very nice to be able to have guaranteed income from your money in this way. So, but you might be thinking, well, I still need to combat inflation. How do I do that? So here's where the stock market comes in. Now, I love the stock market, and here's what I'm doing for myself. My annuity contracts are for me and my wife. Okay, that's for income, that's pension income, that's what we need them for. Okay, for the stock market, we need that for growth. Why? Because we want to combat inflation, and if we allow our money to grow, rule of 72, it's going to double every 7 years. Okay, worst case scenario, maybe it doubles every 10 years. Either way, even if we left half of our portfolio in the stock market and it doubled, let's say we put $400,000 in this, and we put $500,000 in the stock market, like for me, S&P 500, it's going to double. And so I've got another $500,000 to buy more income in 10 years. Okay. And I'm going to be older, so I'm going to buy even more. It'll probably be like $50,000 in additional income. And then I'm going to do it again in 10 years, and I'll just keep doing it. And I'll always have the money that I need, and that's how I combat inflation. And one of the best ways to do it. You don't have to do that amount. A lot of times people will use a large portion for lots of guaranteed income initially, and then they'll use smaller contracts like $100,000, $200,000 contracts, and they'll activate income on those like every 10 years, just depending on what your goals are. So you can do that all at once, or you can spread it out. You could buy a contract that gives you highest income initially. And then what you'll do is you'll just keep your money, in higher yield investments. And then of course, take take the money from that in lump sums and purchase more contracts down the road as your portfolio grows. I love doing that. But we're going to look at some contracts that will give you inflation increases every year. So if you don't want to do that, you just have to put more money in. So that's the trade-off. So let's say I went up here and I said, well, what's the highest increasing income? And we're looking at income riders, by the way. These are income riders attached to fixed index annuities. They typically pay out the most, and people usually like these because they are flexible as far as when you take income. Because you might decide, I want to take income in 3 years, but I might wait 4 or 5 or 6 years, or maybe I'll wait only 1 year and take it. You want to be able to have the flexibility to do that. And with an income rider, you can. Okay, so increasing income. We start that, it's definitely lower. It's not starting me at 35, it's starting me at 29. But Allianz offers a great increasing benefit. So what they do is they will base it off of the growth of the index. Now, I've seen these actual contracts and they do pretty well. You just have to remember that it is not guaranteed. The guaranteed portion is $29,000. Okay, that is guaranteed no matter what. Okay, but that's worst case. That's showing no growth at all. Okay, I've never seen that happen. I've always seen some growth. So if we go down here to just an average growth of 5%, and that's not even every year, that's pretty decent increase. It'll start you out actually a little bit higher at $31,000, and then it'll keep growing every year. And so that's pretty nice. That's a great way to combat inflation. So it is based off of the index growth. You might have more increases in 1 year than another. So, but they're great. They're great contracts. I've seen them work and people do very well with them. But if you're looking for more absolute, you want something that's contractual no matter what the index does, then what you're going to do is you, instead of looking at one of these, you'll go to the SPIA. Okay, a SPIA or a DIA. SPIA is a single premium immediate annuity, or a DIA is a deferred annuity. And so when we look at these, the same $400,000. Okay, and if I was to say, well, I want this to go out 3 years. Okay, we'll just do the same. We want to make sure there's a cash refund just in case I don't use it up. Joint life. Then we go down here and say, all right, so monthly income, $2,576. So that's not bad. We're getting like $30,000 a year, and we're getting that level income for the rest of our life. Now, we want to add a COLA. Now, this is one of the only contracts that you can actually do that. So we're going to go down here and we'll say, we want there to be a guaranteed growth rate of, let's say, 2.5. Okay, we think that we're going to need that, and we want that to increase every year guaranteed. I say, all right, we'll absolutely give that to you. Now it's going to be $2,000. So we're giving you $500 less per month initially, but now you have the guarantee that it's going to grow. It's every single year, it's going to go up 2.5% for the rest of your life. And so you don't have to think about it. The income's always going to be there. You're always going to have an increase, and that's it. So it's really nice. So it's very simple. These contracts, though, they're irrevocable. There is no cash value. You cannot cancel them. So you have to remember they do have their limitations, and you have to select a date, and you usually cannot change those dates. So they're not flexible with like an income rider. So I might go and say, well, what if I want 5% increases? Can I get that? Yes, a couple of them will give it to you. Corbridge will. It's a pretty big increase, but they're going to start your monthly income quite a bit lower. Instead of $2,500 a month, it's like $1,200. So you might look at that and say, all right, well, with 5% increases, how long is it going to take me just to get up to that level income of $2,500 a month? And you might look at it and say, oh, that's going to take me like 10, 15 years. A lot of people look at that and they're like, that is not worth it to me. I'd rather buy a highest level payout, which is usually with an income rider, and then I'll buy several contracts and I'll activate those at different times. That's usually, in my experience, what people will do to create more income as they get older. So anyways, there's a lot of things that you can do as far as combating inflation. But in my opinion, one of the best ways to do it is through one of these COLA riders that you'll put with a SPIA or a DIA, or with an increasing income that you can do with a fixed index annuity with an income rider, or buy multiple contracts. Now, I also wanted to talk about taxes, okay? These are taxable, okay? Now, for this, we're looking at monthly taxable amount of $655. You're looking at that and say, okay, what does that mean? That means they're going to tax you on $655, whatever your tax bracket is. So if it's a 10% tax bracket, your tax is $65 a month. That's what that is. And this is based off of being non-qualified money. Okay, you're putting non-qualified funds in. So some of it is returned tax-free and some of it is considered earnings and they tax you on it. So that's how it works with non-qualified. If it's an IRA, we all know that your tax as ordinary income. It does not matter if you have an annuity contract in there or not. Anything that comes out of an IRA or 401k is taxable as ordinary income, unless it's a Roth. Okay. And some of these companies, these insurance companies, will allow you to convert to a Roth, either a partial or a full, after purchasing the annuity contract. Otherwise, most of them, you just better convert it to a Roth before, and then you can avoid all the taxes, and it's 100% tax-free for the rest of your life, which is very popular right now. So I'm going to go back to the income rider just so you can see. I just want to look at, just when we look at the funding, I mean, I'm saying any funding here, but I might say, well, I'm going to do a Roth. Okay, I'm going to do a Roth. The income is not going to change. Okay. Let me take the increasing income off here. So the income's not going to change. We're deferring out for 5 years this time. And now it's $40,000. Okay. But since it's a Roth, it's $40,000 tax-free. That's it. $40,000 tax-free. It's great. You take this out for 30 years, you're taking out $1.2 million tax-free income. It's that simple. And the balance is not going to last. Okay. The balance will deplete after a while, but it's still tax-free income. Okay. It does not stop because it's coming out of the Roth bucket. So if you go in there, you say, all right, 40,000, even with index earnings, it's still not going to last. The account balance won't last till you're, maybe 81, 82, but that income keeps going. That's pretty nice. Pretty decent payout right there. If you do die and you're taking this as a joint payout, you and your spouse die while taking income and there's still money in the account, it will go to your beneficiaries. You'll see here, see the death benefit column? Yeah, that goes to your beneficiaries. It'll run out eventually because your account balance runs out, but it's your money. You're just leveraging it for a higher pension payout for yourself, but it doesn't go to the insurance company when you die. Okay. So anyways, it's really simple. That's the way it would work if you did a Roth. Now, let me go back to here and I want you to see there are certain companies here that I know will allow you to do a partial or a full Roth conversion, okay? A lot of these will not allow you to do that. So you better do a Roth conversion or have a Roth before you purchase this annuity. And that's what these top ones, okay? Athene is one of the top ones. They will allow you to do Roth conversions, either partial or full. So that's good. And that's after buying it. So you might decide, well, I'm going to buy an annuity right now with my IRA, but I don't want to retire until 5 years from now. I want to do partial Roth conversions from here until I start taking income. And then by the time I start taking income, it's going to be all converted over. That's what you can do, but you can only do it with certain companies. So Athene, they're one of them. American Equity, they're another. So the PAs are a little bit lower on these, but they are the ones that do it. Midland National also will do it, $36,800. So definitely lower income, but these are the ones that will actually allow you to do those. So you have to just think forward on this. If you are wanting to convert to a Roth, and you absolutely are sure you're going to do it, then make sure you pick the company that is the best company that will allow you to do that. Because if you pick one of these that don't, then you're stuck. I mean, you still get your guaranteed income, but you cannot convert it to a Roth. Okay, so just that's how you avoid taxes, though, is converting it to a Roth or already having Roth funds, or putting in non-qualified funds and realizing that you are going to get lots of years of mostly tax-free income, for a while until they give you back your original principal. And then you're going to be fully taxed because everything's 100% benefit from the company. So anyways, hope this helps. If it has, make sure you like, subscribe, share. If you want to buy an annuity, there is a link below this video. It goes directly to my calendar and we can talk about all your annuity questions. If you're just curious about what annuities pay out, go to my website. It's johnstevenson.com. I've got my calculators there that will show you all of the annuities that are available. And then you can put in all your information and it'll spit out the calculations for you. If you're married, it'll give you a joint payout. And put in your email. It'll send it to your email. I'm not going to spam you or anything. It's literally just to send you the quote. Okay, so that's what it's for. And then at that point, if you feel comfortable reaching out and you are still wanting, hey, I think I'd like to talk to John and possibly get an annuity, then absolutely you can book a call there as well. So anyways, hope this helps. I really appreciate you watching and we'll see you soon.